Scammed out of life savings. I am sure that I am not the only one that got at least one phone call this past year that, can I help out a taxpayer in a situation? When this question came in, I was like, we need to use this question. So let me give you the scenario here. Taxpayer was coaxed into withdrawing $2.3 million from their IRAs to invest in an LLC. There's roughly $600,000 withheld. The transfer was done December 25 and January 26. By the end of January 26, the LLC disappears. 25 is showing a $500,000 tax liability based on the withdrawal after the withholding. The client does report the loss to the FBI in January of 26. Client now only has Social Security income. That's all that's left. First question, because there's a little bit to this, is kind of a two-step process, but the first question I'm going to ask is, David, since you really didn't participate in the last one too much, I'll let you start this one off. Let me start with the broad picture here. Is there a deductible loss here? The concept is went from one investment, the IRA, to an LLC new investment. Is there a potential deductible loss?
I would say there absolutely is.
Okay, and under what would that be?
Under 165, I don't know if this is paragraph 2 or C2. This was an investment made into a for-profit venture, or the intention of a for-profit venture, whether or not it actually existed. So the intention was there. The investment was actually made. The fact that this was a fraudulent scheme was not the fault of the taxpayer, at least within the eyes of tax law. Whether or not they do due diligence, that's a separate matter. But under 165C2, it's absolutely a deductible loss in the year that the loss is discovered.
The year that the loss was discovered. Could that be an issue with this scenario, since the withdrawal was in 25 and the tax liability is 25, the loss is discovered in 26? Does that become a problem?
It's a huge timing issue because you're going to have the income recognition in the year before you discover the loss.
So now we have a taxpayer that's only collecting Social Security going forward. How much of that loss will they be able to recognize, if any?
Well, they'd be able to write off the entire loss, but the problem is it's going to generate an NOL that we can't carry back anymore. So they're effectively going to be carrying it forward indefinitely until they have income, which doesn't help because they already have a tax liability for the prior year, and they don't have the means to generate a tax refund to pay it.
So it is fully deductible. Is this considered, the question that comes up a lot, I hear when I hear these scenarios out there and I see them on different web boards that I monitor, does this count as a Ponzi loss? Because that's automatically everybody thinks, well, if it's fully deductible, it's got to be a Ponzi loss.
Yeah, I would say probably not. And the reason being is, first of all, there needs to be a criminal indictment, right, as I recall, under the Rev Proc back from 2009.
Okay.
For those of you who remember Bernie Madoff.
Yeah, right. Those of you who remember. Now, there was we did get some guidance recently, Mark, on this, on what constitutes this deductible loss versus what doesn't. And do you remember where that was?
It came directly from a chief counsel advice.
Okay.
And they gave us 5 scenarios in that chief counsel advice that said, of these 5 different types of things, people getting scammed for an investment scam, or for the greatest crypto thing, or pig butchering where they keep building someone up and then eventually then it becomes pork chops. Those are all investment related. People put money into the scammer, with the scammer, with the intention of making more money. So there was that income producing activity that they were looking at. And then there are 2 scenarios where they say, you got scammed and it's not going to do you any good for taxes, and that was the romance scam. And I think I'm chatting with some 23-year-old European beauty, and it turns out it's some 50-year-old Venezuelan man. And they've convinced me that,
This seems to be a little personal, don't you think, folks?
just asking for a friend. So those ones, those don't work. Or the kidnapping scam, which is gotten more and more popular, especially with generative AI, where you can get someone's voice and copy them. So suddenly you get a call from your grandchild. I'm in a jail in Mexico and I need $10,000 cash for bail to get me out, or they're going to, or I'm going to be, meat. And so please, Grandma, wire the money here. And those aren't investment related. Those are, personal, and those don't get losses. But the chief counsel advice goes through each and every scenario to the point where you could really follow them and almost identify your particular client along with it. Very easy. And good, solid law at this point.
Okay, that's good to know. Laura, let's see what we can do to help out this practitioner who advises his client.
So this is a heartbreaking situation because it crossed years. I've had a number, sadly, of these in my practice, and I now, every elder client, every client, not to. Anyway, fortunately, in my practice, they all happened in the same year. In most cases, they knew they were scammed within days, if not hours. This one, it had that crossing of the years. Even though it does qualify, it doesn't qualify in the year we have the problem. Offer and compromise is pretty much going to be our answer. Now, there's 3 different kinds of offer and compromise, right? I owe you, but I'm never going to be able to pay you. That may or may not be the situation. This person, everything they've got is gone other than Social Security, or do they have non-liquid assets like the house they live in, paid off in the San Francisco Bay Area? Well, they may be living on Social Security, but in theory, they could pay the IRS the tax due. There is another one that is for effective tax administration. I think that's the one I would go with, is it's not fair because of the crossing of the years.
Well, my dad always said nobody said life was going to be fair.
I know, life isn't fair, but that is what that is for, is that the consequences are so extreme, it's in the government's best interest on behalf of the client to perhaps yield a little bit of mercy. However, this is a California client, so what's going to happen with California? Does California show mercy?
Interestingly enough, no. But let me just throwing this scenario out there, and it could be a potential advising your client. If they do have that house with that equity, potentially, I don't know if anybody's familiar with the San Francisco Bay Area, but the price, the housing values pretty much double every 10, 15 years. And most houses that my clients have sold have had more than that 500,000, 121 exclusion. Having this potential loss, would that not offset that, give them some cash flow, and potentially help out the situation a little bit? As a possibility. It depends on how much equity we're talking about. My client's now living on Social Security. Even if they've had that house for a while, there's still a $2,000, $3,000, $4,000 a year property tax bill. Insurance in California is going through the roof. I mean, these expenses on Social Security are pretty high. It might be another way to advise, but I'm throwing this out there just as another thought pattern.
What is your experience with the IRS accepting ETA OICs? That would be the first thing I'd want to look at. I haven't heard a lot of kind comments about the IRS accepting those.
I have not seen one personally. I can't say. And Tom, that's your world.
Yeah, OIC I think is an option. I also would look at currently non-collectible or CNC, right? If we can show that selling the house and the assets, getting that equity would be a hardship, maybe we'll just get them to stop collection action, and then we just let the collection statute run and see if they can wait out the debt for 10 years. That could be another possibility.
Tom, what if they don't?
Or 20 for California.
Or, well, California, yeah.
Or 30 if they want.
And if they don't own the home, so let's just take the person that lives in California or anywhere else without that home ownership, could you do a long-range plan and say, bankruptcy is not a bad option here?
That's true. You can use bankruptcy for tax debts. They have to meet 3 requirements. And the key is to find a qualified bankruptcy attorney who understands taxes and bankruptcy, because some do not.
Some.
David says some. It's actually most don't understand it, unfortunately.
Anything else we want to add to this as a possible solution to this poor person's, I'm sorry, I shouldn't say poor, this person's unfortunate situation?
Take away their cell phone.
Take away their cell phone. It's, I had a client this morning leave me a voicemail, and they got a call from Washington, D.C., left a voicemail, it was very urgent. And and my client is one of these people that it would be easy to fall into that situation. They called me before they called back, fortunately. And I said to them, if they by chance answer the phone, and make sure they were both on the speakerphone. Charlotte, is Barry there? Yes, they're both on. They answered. I said, if they call back, you tell them that you're not allowed to talk about your taxes, only I am, and give them my phone number. And Charlotte says, well, what's your phone number again? You just called me. But I said, give them any phone number. They're not going to call me anyways. I gave her my phone number again. But that is, we have to be helping our clients. Unfortunately, these things are out there. I talk to my clients. My dad is 80 years old. He got that phone call 2 weeks ago that me or my brother were in jail. He didn't know which one of us, but he felt pretty confident neither one of us were in jail. And he told him to go take a hike.
I don't know, Alan. I think you could have been in jail.
Not for anything I've done lately.